Hi, I'm Richard Murphy, and this is the 19th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we're exploring the importance of customs and excise duties, tariffs and license fees in any tax system. These duties, tariffs and charges probably have a greater significance in the tax systems of many lower income countries than they do in the tax systems of major economic powers. That is because, subject to the goals of the tax strategy of a jurisdiction, these taxes and charges can be targeted as specific sales taxes on what are very often high value, easily identifiable, and relatively low volume transactions. This makes them stand out in marked contrast to charges like value-added tax, which are much more general in nature, but have the same broad objective of charging sales to tax. This means that these taxes can be focused in their purpose, specific to local situations, easily adapted to new circumstances, relatively straightforward to administer, and applicable to relatively few taxpayers, and so be cost-effective to administer. The consequence is that higher than average levels of tax compliance might be achieved with these charges. That said, the risk of smuggling and evasion is often high when it comes to these taxes, and counterfeit goods sold through the shadow economy are often a problem that the higher prices created by these charges can exacerbate. As with any tax, it is vital that the government of a jurisdiction explain and engage with the public regarding its reason for imposing the customs and excise duties, tariffs and license fees that it proposes to charge. Those reasons should be set out in its tax strategy, which, as has already been noted, should ideally be updated annually as part of its budget process. The reason for these taxes and charges will vary widely depending upon the jurisdiction involved. Some of the likely basis for charges include, firstly, to deliver social policy requiring charges to counter the cost to society from consumption of some products and services, such as alcohol, tobacco, carbon, and gambling. Secondly, they can be used to raise revenue from the extractive industries requiring license fees on granting concessions and royalties on export sales. Thirdly, they can be used to protect local and growing industries by the use of tariffs, protecting such things as new manufacturing bases. Lastly, industries created to substitute for imported products, and sectors subject to aggressive international pricing. There must be transparency about these decisions, and public consultations should take place when changes in policy occur. The above being noted, there is frequently international pressure to reduce these customs and excise duties, tariffs and license fees in any tax system. For example, the so-called Washington Consensus imposed by the International Monetary Fund and the World Bank frequently required that these charges be reduced or eliminated because they were seen, whether rightly or wrongly, as impediments to competition in open markets. Jurisdictions may need to discuss the impact of international agreements relating to these charges in their tax strategies so that there is awareness about the constraints under which they are operating. There will also be a need for a widely publicized anti-smuggling and illicit goods strategy if these charges are to be used on commonly consumed items, and a program of publicity about deterrence that might exist and could be used against those committing these offences. The points already made in this video series on disseminating information on tax will be important in this context and should be referred to for further information on how we think this topic should be approached. Tax transparency and public engagement on these charges is vital if they are to be used successfully.